Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm really pleased to have with me once again Doug Noland. Doug has been on this show a couple of times in the past, not nearly often enough in my view, but he is currently the portfolio manager for the tactical short strategy at McIlvaney Wealth Management. Many of you know David McIlvaney, who's been a frequent guest on this show, so Doug and David work together. Previously, Doug served as a senior vice president and portfolio manager of Federated Equity Management Company and overseeing the Prudent Bear Fund. And I've known Doug for quite some time now. In the old days when he worked with David Tice at David W. Tice and Associates. Welcome, Doug, and thank you so much for joining me again.
Hey, it's great to be back, Jay. Thanks for having me.
Well, it's always good to have you. You are certainly a person that knows these markets as well as anyone. You are very familiar with the credit markets, and which leads me to ask you, Alistair McLeod is a frequent guest on this show, and he likes to stress the point that, everybody in the mainstream media, at least, they talk about the business cycle. He says that's hogwash. It's not a business cycle, it's a credit cycle. He says that the business environment is driven by credit. It's not that credit is responding to business. Would you agree with that?
Yeah, absolutely, Jay. And it's a credit cycle, it's a financial cycle, and it's a cycle, driven by policymaking in particular. That's what makes this a lot different than, the traditional business cycle that we've read about throughout history.
We've read about throughout history, but as almost since I've known you and David Tice, it seems like the intervention in the markets have gotten bigger and bigger with each cycle. Would you agree with that?
Sure. And, Jay, for me, this has been almost a 30-year experiment going back to the early 1990s with Alan Greenspan, when he started to, tinker with monetary policy to help the new type of finance that was expanding, the market-based finance, asset-backed securities and derivatives and all the marketable debt, and it just took on a life of its own, and the intervention has become more aggressive. It started with Greenspan at tinkering around 25 basis point interest rates, and now we're doing trillions of QE in not that many weeks. So it's been quite an evolution in policymaking.
Well, we've got to do trillions upon trillions upon trillions now, not just to keep the banking system alive and keep it from falling and imploding, but also now in fiscal, I don't even want to call it stimulus, because it seems like it's just money that's being created to try to keep a society, the social order in place, and it doesn't even seem as though they're doing that great a job in that regard. Not far from where you live in Portland, Oregon, we've seen night after night disruptions with Marxist groups that really don't have too much good to say about a free market economy. Not that we've had one for any length of time. I mean, it seems like we've been departing from free market economics more and more as time goes on. I think you would agree with that. And that's part of that policy that the Federal Reserve has gotten involved with, right?
That's correct. And, I've spent a lot of time over the years, decades now, studying credit, right? And I was convinced that we had fundamentally changed finance in the 1990s, and we created a bubble, and this bubble has been inflating, now for a long time. And the problem with bubbles is, while they're inflating, it looks like everything's great. The economy is plugging along. The markets can be at all-time highs. People feel wealthy. But at their heart, bubbles are mechanisms of wealth redistribution and wealth destruction. And we're seeing the bubble falter now, and we're seeing society, a lot of stress in society because people feel that the system's not fair. And even in the last few months, we've seen, incredible stimulus, monetary and fiscal. The markets have gone basically back to all-time highs, but yet most people in the country feel that they're not sharing in this policy stimulus, that the policy stimulus is directed at the markets supporting the wealthy. And unfortunately, they have a point, right? They have a point because years ago, the Fed changed the whole MO here as far as how they manage monetary policy. They used to tinker with rates to stimulate the banking system to lend more or to lend less, depending on their intentions. Well, they shifted, and now they go directly to the markets. And again, it's that trillion number, and we're seeing the cost here with a lot of uneasiness in society, distrust in our institutions, distrust in the Federal Reserve and Washington policymaking generally, unfortunately.
Yeah. So what tools do they have? The Fed likes to talk about tools in its toolbox as if it has some ability to fool Mother Nature or to fool the markets, the natural forces of markets. This is such hubris, it seems to me, Doug. And they like to talk about, oh, never mind, we have this under control. They said after Bernanke was convinced that they could return and normalize the balance sheet, or so he said he was convinced. I don't know if he really was. Normalization of the Fed's balance sheet. Is there a chance in a snowball's chance in that hot place that will ever happen?
No, I don't think so. If you get into a situation where all of a sudden you have the hedge funds and I call it the leverage speculating community, if they're putting on a lot of leverage again, then that gives the Fed the leeway to pull back on its balance sheet some. It's almost like the hedge funds can create their own liquidity, so the Fed can pull back some of the liquidity that they put into the system. Uh-huh. But that will reverse very quickly the next bout of de-risking, deleveraging that we have. We saw in March how quickly this unravels. When you get a risk off, when you get the hedge funds, the derivative players de-risking, deleveraging, there are no buyers. And it's the Fed and the global central bank community that are basically the buyers of the last resort, the liquidity creators, and so they'll have to come right back with trillions more of liquidity. So I don't think they can get out of this now. They're trapped by the enormity of the global speculative leverage that we got a hint of in March. And I'll add that the Fed acted so quickly, right? It was like 10 sessions from all-time highs to emergency meetings and liquidity injections. So they were able to stop or halt this de-risking, deleveraging. But in the future, I don't think it will be so easy to reverse that. But we'll see.
Do you think they've learned something in terms of the need to act quickly to get out ahead of it from 2008? And so this time they were more prepared, ready to jump on it aggressively?
Correct. And I would actually say they learned a lot from 1994. 1994 was the last actual tightening cycle that they had. And they learned in 1994 that things can spiral out of control quickly. So after 1994, they only moved very, very gradually. They signaled to the markets that they won't do anything to upset the markets. And let's face it now, we're a year into QE. QE didn't start in March. QE started last September. Mm-hmm. And that's when they came out with this so-called insurance, the insurance stimulus, where they were saying, okay, we've got to act aggressively and quickly. And all that did was throw gas on the speculative fire, last fall that led to an even more difficult dilemma for the central banks in March when that part of the bubble started to unravel.
Yeah, it was last September. I think the repo problem is what sort of triggered and caused some people to start wondering and thinking that maybe we're approaching some real issues again. I wonder, Doug, how high did the 10-year get when we finally? I think 10-year or whatever interest rate you want to look at. What was the breaking point back in March about where did we? I mean, how high did rates get to in this attempt to renormalize the balance sheet?
Yeah, I wish I had my Bloomberg screen in front of me right now.
But from memory, I'm thinking
we were over 3%. Yeah. The yields had started to come in. Earlier this year, because the safe haven markets they sensed fragility out there, which they often do, and let's face it, although the safe haven yields are up today, but in the spite of equities rallying back to record highs, and despite corporate credit booming, the safe haven yields have stayed remarkably low. Basically, the 10-year yield all-time lows just a few sessions ago. So I think they're signaling that there's a lot of fragility out there, and that I look at the safe havens as confirming my bubble analysis. The safe haven yields are so low because they recognize this is a bubble. The stocks, when they turn speculative, are very short-term focused. The safe havens, be it the precious metals or the bonds or the treasury yields, they look out longer term. They don't care about the next few weeks or even a few months. They see troubles on the horizon, and that explains yields. We saw the same thing back in 07, 08, where the safe havens started playing their own game, ignoring booming stocks.
Who in the world is buying treasuries now, and why would you buy them?
Well, they're a safe haven.
Yeah, I guess that's it.
The Fed injects trillions of dollars of liquidity into the system, right? So that liquidity has to go somewhere. The Fed bought an enormous amount of treasuries, and institutions. There are buyers out there that don't trust corporate credit or don't trust equities, and there's the view that the treasury yields that treasury bonds are a hedge also. That if you own stocks, if you own some treasuries, then that protects you against potential problems in the equity market. I think it's one of the worst risk-reward trades out there, right? The yields are so unappealing, but all this money has to go somewhere, I guess.
Yeah, I mean, you got negative real yields. I guess you could say that with confidence, and then
Correct.
And then you have to pay taxes on the interest that you make on those instruments. So I just wondered. I guess the money has to go somewhere, as you say. But who is buying the treasury? I mean, to what extent is the government financing the treasury market? I guess that's what I'd be interested in knowing. Well, that is the Fed. The Fed, I mean.
Yeah, the Fed, of course. Yeah, they've been an enormous buyer. They basically monetized these massive deficits. Not the entire deficit this year, but they'll monetize a large part of it. Basically, they just go out and create new money to buy treasury bonds. It's the Fed is by far the biggest buyer of treasuries, without a doubt. Yeah.
So to what extent? I mean, COVID-19 comes along, and of course that really knocks the heck out of the out of the economy. How bad do you think this economy is, Doug?
Well, Jay, I hope I'm wrong on this, but I think this has been, the biggest bubble in the history of mankind, and it's been going on for decades, and there are just enormous imbalances in the economy. The financial market, it's an accident waiting to happen. So I fear when this bubble bursts, and I'm not talking about a stock market bubble. That's one component of it, but it's corporate credit. It's, treasury bonds. It's central bank credit, it's domestic, it's global, right? I call it the global government finance bubble, right? This bubble, it's gone to the heart of global money and credit. It's gone to central bank credit, it's gone to sovereign debt. So when this bubble blows up here, I think there's a real crisis of confidence, not only in policymaking and all this credit, but also in economic structure. And this, this multi-decade experiment, I think, unfortunately fails, and we're going to have to rebuild out of it and create a different economic structure, a different financial structure, and it's going to take a long time, and it's going to be really difficult, I fear. Yeah,
and it's global. It seems it's not just the United States. It's not just the Western world.
Oh, absolutely, and that's one of the keys of over the past decade. And I thought the bubble had burst in 2008, and in my weekly credit bubble bulletin, in I think it was March or April of 2009, I had to change my story, and I started warning of the global government finance bubble. And to watch what's unfolded in China, where their banking system is basically gone from $8 trillion US dollars to 45 trillion. There's never been anything like this in history. So China is a historic bubble that's increasingly vulnerable. The emerging markets have participated in this global bubble. It's global. It's so much bigger than the mortgage finance bubble from back in 2008 that blew up. So that's part of the reason that I'm so concerned. And again, Jay, this is back to this theme of bubbles are about, wealth redistribution and destruction. Yeah. All of a sudden, geopolitical becomes a major issue. We briefly addressed the social stress from the inequalities here in the U.S. Mm-hmm. Well, we're starting to see the impact of bubble trouble globally and increasing animosity, conflicts. You're now seeing the U.S. and China rivals for global superpower status. Mm-hmm. So the ramifications from a bursting global bubble are far-reaching. I'll leave it at that.
Yeah, that really would seem to be the case. But still, the Fed has the printing press. It can print money. It seems almost indefinitely. Ray Dalio has recently talked about, speculated what would cause it to break down, what would cause the Fed to no longer be able to continue on doing what it's doing. It's got the printing press. It can always issue pieces of paper or issue digits to pay off whatever obligations the government has. But I saw Danielle DiMartino Booth talk about 13% increase in Chinese inflation, food inflation. You were just talking about how the Chinese have been expanding their balance sheet, the financial system. At some point, you would think there would be a confidence lost in the system if those pieces of paper, those government transfer payments, still don't allow people to pay their rent and buy food at some point in time. That, God forbid, but that seems to be something that's really, certainly has crossed my mind a lot, given the exponential rate of credit and money creation. What are your thoughts? What could cause this thing to end, I guess is the question.
Sure. And yeah, the perception in the market, and I think these perceptions always follow the stock market, right? So the stock market's been on a huge run, so everybody's optimistic, and they think, okay, we can have fiscal and monetary stimulus. We can have trillions for forever, right? Well, I don't think the Fed is completely reckless. I don't think that they would plan on, trillions at a whim. Mm-hmm. I think in Washington for fiscal policy, there's going to be, we're already seeing it. There's going to be some real disagreements. It's the Democrats and Republicans are not going to be able to sit down and agree on trillions of new fiscal stimulus and how it's distributed, mm-hmm. right? So there's real political consequences there. As far as the Fed, if we saw an uptick in inflation, I think they would get cautious. If the downturn in the dollar accelerates, I think the Fed would be more cautious with QE. If bond yields reverse and move higher, that would put a lot of pressure on the Federal Reserve not to be reckless with money expansion, money printing. So there's a lot of things that can get in the way here. But I'll also say we've seen since March, the Fed creates all this money, and all it does is it makes this speculative bubble more intense. And to me, that's self-defeating, right? That's just creating a bigger problem. They can make the stock market go up, and we can, have more day trading, and more people can buy call options and Tesla and all of that. But all that does is create more fragility. So I kind of think we're in the end game here where they're throwing a lot of money at this to try to keep the bubble from imploding. But at the end of the day, I don't think they're going to be able to control it because the speculative bubble is too big, it's global, and it only works when it's inflating. The next time we have a big downdraft in the markets, then we're right back in a pickle, I think.
Mm-hmm. I just can't imagine rising bond yields, as you said. The risk-off instruments, I guess the Treasuries were down and the rates were up significantly today. Is that right? And I just can't imagine. I don't see how interest rates can rise at all, ever again, given the amount of debt in the situation that we're in. So it seems to me as soon as the bond yields start to rise, the Fed has to almost get more involved and pump more money in the system, don't they?
I think that's yes. Realistically, yes. We saw in March, illiquidity in the Treasury market in March. there was a dislocation because of all the leverage that the hedge funds and they have these different yield curve trades, et cetera, and that started to unwind. And again, they can make that bubble bigger, but I don't think that resolves anything. And Jay, we've argued, for years now that all this money printing, all this monetary inflation, it's not part of the solution. It's part of the problem, right?
Yeah, exactly.
And to think that they're going to be able to get out of this muck, out of this mess by expanding their balance sheet, it's not going to work.
They can't do it. Doug, just real quickly, because we're out of time, what are you doing in your fund now? How are you preparing? What sort of things are you buying, or what are you doing in your hedge fund?
Sure. Yeah, and it's not a hedge fund. It's actually a separately managed account.
So
in McAlvany Wealth Management, we have our MAP strategy, which is a long, hard asset type plays. I am also managing the tactical short, which is a hedging product, short to market, and I'm just very defensive right now, just trying not to lose much.
Yeah, right, exactly. Doug, thank you so much. Sorry to cut you off here because I know you had so much more to say, and we'll have to do it again sometime if you're willing to come back. Thank you so much.
Always happy to be with you, Jay. Thank you very much.